In today's video, I will be talking a little bit about, let's say, easy investing and more precisely 3 ETFs that you should know about. So yeah, this is going to be a little bit of a PowerPoint. It's going to be super chill, relaxed from, let's say, the hashtag without too much fuss. So it's just going to be something really chill. We're just going to be talking about this easy, nothing too much to, let's say, think about. And yeah, let's basically start with the table of contents. So first of all, I will be talking a little bit about the strategy that we'll be using, that let's say I'm using more precisely. The category one for all, the essentials, dividends, international and growth, and some examples. But before we start, I have to say that this video, as always, is not financial advice, and also this video is not sponsored because I will be using a broker, which is going to be Trade Republic. I'm not sponsored, but I wish Trade Republic, if you're watching this video, hey, how are things? I finished my master's, so if you want to, I don't know, kind of like safe, reliable, I don't know, haha. So basically, yeah, I'm not giving financial advices. Those are, let's say, kind of my own opinion and a little bit of my own, let's say, kind of like type of research, my own type of, let's say, kind of work. So also, you know that basically when you watch a video, the video is never enough to make you make a big decision or things like that. So it's just something that could give you a little bit of context or just a little bit of, let's say, information, but like not financial advice, no advice. It's just, let's say, context, entertainment. So yeah, because this is a chill video, we are chill people, this is something relaxed, so we'll be just talking about those things, especially because like on YouTube there are like humongous and especially a lot of people making videos. So especially going more into detail, this is going to be a little bit more chill, more relaxed. And yeah, especially because like the main purpose is going to be talking a little bit about the being more aware, a little bit of the stonks things. So yeah, that's gonna be the main reasoning behind it. So starting, so what's the strategy that I will be using? The strategy is gonna be to basically use 3 ETFs, which in my opinion, the ETF is, let's say, kind of the best long-term financial instruments, because we have a lot of financial assets or like instruments such as stocks, bonds, and so on. But I think that ETFs, which basically have more stocks altogether, they represent something that it's like more, I will not say safe, because not financial investment is ever safe, but I would say that it has a little bit of more diversification. So let's say it has more things. So if one stock goes bad, maybe another one goes well, and things balance each other. That's kind of like the reasoning. Then what's the one from all? The one from all, it's basically one ETF from each category, because we saw the 3 categories, and I think that basically the best idea would be to kind of have one from each one, let's say, kind of that's the main reasoning. So basically getting the best of everything, no? And then diversification. The whole concept of ETFs is to actually have like a diversified portfolio, but let's say that both ETFs, as you will see, they're gonna have a little bit of diversification or no diversification, especially talking about countries and sectors. So that's gonna be a little bit important. So also, of course, in the world of investing, it's really important to know what you have in your hands and to have different, let's say, kind of sectors, exposition, being exposed to different type of sectors. So yeah, that's kind of like the whole reasoning behind it. And of course, the strategy of investing in those type of assets, it's also to kind of like not become super rich, because it's really, really difficult to become rich, especially like investing and things like that. But it is kind of to maintain the level of wealth, because as we have inflation, which typically should be around 2%, it should be, but we have it like higher sometimes. So let's say since money kind of like lose their value at this point, having the money instead of like having them like staying kind of cash, it's good to have cash, like I'm not saying that, to having them like stayed, it might be a good idea, obviously not financial advice, to have them invested in something that kind of like increase their value over time. So yeah, of course, but then we have to talk about taxes, income taxes, not income taxes, sorry. We have to talk about, let's say, the taxes, the expenses, and so on. So there are a lot of things, but chill, relax, because the main purpose here is money. So super chill, no, just joking. So basically, what's the reasoning on of one for all? It's basically, yeah, giving a little bit of the Lord of the Ring vibes. I would say that it's kind of easy to be exposed to the market, especially by choosing just one of those type of ETFs, because like some of the best ETFs, and especially those who have like the major exposure in the markets, but also the major type of investments, they are the most famous one and kind of like get the best industries and companies. So yeah, kind of having just one for all, it's kind of like, I would say, yeah, something interesting. So definitely something to kind of like keep in mind. But starting now, going from the first category, which is the essentials, reasoning behind it is to kind of have like an exposure to the market. And one of the best and well-known ETFs that kind of tracks the market is the S&P 500. And yeah, basically it's super famous because it tracks, let's say, kind of like the most market capitalized companies, industries in America, public companies. So in this case, we have a complete exposure to the US. So this could be a good thing because like the US, we know that basically it's one of the strongest, if not the strongest economy in the world. Even though now things are getting a little bit shaky, and not just by the president, but also because like everyone is saying that markets have reached another peak. So being careful a little bit. But also this could be like a bad thing because what if in America gets like a crisis? Let's just think about like 2008 crisis or the crisis in 2020. This could have like a domino effect on like the whole economy, and since this basically S&P 500 is particularly exposed in the US, this could be like a bad thing. But looking a little bit at the sectors, we can see that basically the majority is into information technology, the financial, and healthcare. And as the composition, we see that basically the most, let's say, bought company is the Apple. Then we have Nvidia, Microsoft, Amazon, and Meta. So we have a huge presence in the US market. And yeah, let's say that these companies are some of the most well-known and most profitable. So we have companies that are kind of like showed that they're capable of lasting during the time. So kind of like keep up and be profitable. And as we can see from the graph, let's say that in just 5-year time period, because usually I would watch a longer time frame, but like this is the only one available. Let's say the longest one available. In the 5 years time, we can see the graph that the basically price 5 years ago was around 265 euros, because we're talking euros, we are in Europe. And the only, let's say, kind of big dip was basically at the beginning of 2020. And we know why, basically. Then we had like a huge increase when the economy was starting to recover, or like, let's say, the bonuses and let's say the incentives to kind of like have the economy to rise up. Then we had a little bit of a flat status when we had the beginning of like the conflict between Russia and Ukraine. And then we had basically after the, let's say, kind of once things stabilized, we had like this huge increase in basically just the recent years. And basically now the S&P 500 is touching like the 610 euros. So it's a lot. But as the second one, now the other one, if by any chance the S&P 500 is not that appealing, there's also core MSCI World. In this case, there is like a more exposition into the information technology, once again, financial and healthcare. But we see that once again, there's a huge exposition to the US market, but this time at least, there is a little bit of Japan, United Kingdom, Canada, and so on. And once again, the composition is kind of like staying the same one. So Apple, Nvidia, Microsoft. So even though it has a little bit of other parts of the world, the MSCI, it's still kind of like looking towards the US economy way too much. Then now we look at the second category, which is the dividends. So the dividends, what it is, basically when you have a share, some shares, by keeping those shares, so investing money, giving the money to own this share from time to time, which could be like monthly, 2 months, 3 months, or so on, they give you, let's say, some money from owning those type of shares. And those ETFs, they're let's say they focus mostly to kind of like invest in companies that give you a lot of, let's say, money on the share that you own. So one of those ETFs is the stocks global dividend. So in this case, we have like a big exposition to the financial market. So let's say the 40%, so it's a lot, then utilities and energy. And we can see that in this case, this is really diversified because there's like almost, let's say, kind of an equal distribution between US, Hong Kong, Australia, and UK. So we have a little bit of, let's say, more diversification and a way to kind of like be, I will not say safer, but a little bit. So yeah, basically the composition is mostly focusing into banks, insurance, and post. So companies that kind of like will last no matter what, kinda. Too big to fail, who knows. And looking a little bit at the graph, we see that this was highly affected by the 2020 period. Then it had like quite a big increase. Then once again, a big decrease, especially since a lot of, let's say, kind of things happened between the financial system once the conflict between Russia and Ukraine started. And now the ETF is back once again at, let's say, kind of like the same levels that it was around like 2022. Most important thing is that it has like almost a 4% dividend distribution. So it's quite high. It could be like the MSCI World Quality Dividend. But in this case, we're focusing once again more on the US. So there's an exposition to almost 51%, almost 52% to the US. And let's say most investor companies, sectors, are more into the information, healthcare, and industrial. So once again, this is kind of like a little bit on the same line as the S&P and the previous ones that we saw in the essentials. But at the same time, the main focus will be to kind of like see those companies that give you dividends. Then we have the third and final category, which is international, Mr. Worldwide, and growth. So is to kind of like have something that is exposed more to the broad market, but also something that has a little bit of more edge to kind of like grow exponentially. Because like in the past twos, they show a little bit quite like a reasonable, steady growth, but let's say that these ones, they can have the chance to grow a lot, but at the same time, they can have the chance to kind of like bomb a lot, kind of. Not bomb a lot, but like, let's say, you have to kind of like be careful, especially because the very first one is the EQQQ Nasdaq 100. So basically this is, let's say, kind of like an ETF that tries to replicate the Nasdaq. So in this case, we have like an exposition to almost 96% to the US, which is humongous. It's a lot. And once again, the main focus is internet and software, electronics, and consumer staples. So the reasoning behind this ETF is that those companies are either really kind of like stable, but also they have the chance to kind of like increase a lot in their value. So yeah, especially because the composition is once again Apple, Microsoft, Nvidia, Amazon, Broadcom, and other type of companies. So looking a little bit at the graph, we can see that, I mean, the growth that it had in the 5-year time period is not as different from the growth of the S&P 500, even though this one might have the chance to increase even more. As alternative, this could be the MSCI Europe Growth. So in this case, there is like a more exposition to the European market. So we have United Kingdom, which even though is not part of the EU still, France, Switzerland, and Germany. So there is like quite a big diversification, and also the sectors are more concentrated into like the most important ones, such as pharmaceutics, textiles, internet and software, and electronics, and then aviation as well. So the composition, it's also structured a lot into like kind of the big, let's say, industries that should stay no matter what, in type of crisis or not. So let's say SAP, LVMH, AstraZeneca, and so on. So Nordisk as well. So we have like a lot of industries that are like kind of being able to stay there, to stay the test of time. Then finally, reaching the end of the video, what would be the strategy? So looking at this really nice image, I would say that a good idea will be that one to kind of like balance things. And it's really difficult to know what to do, especially because like everyone has a different situation, everyone has different expectation, different type of background, different type of like financial availability and so on. So it's super difficult. But one thing that it could be is to kind of like maybe from someone to kind of like invest one third, and one third. So let's say just to invest to have like an exposition to exposure, exposition to have an exposure to all these, let's say, categories. But at the same time, from someone, let's say maybe a little bit younger, you'll be more interested to maybe invest into something that could have like a big potential to growth. But at the same time, for someone who's like a little bit older, maybe you'll be more interested to get into more the dividends one. So it's really difficult to know what to do. And yeah, this was just a little bit of kind of like an overview. I would say that, yeah, everything it's kind of like difficult to know what to say and what to do, especially because like each one of us needs to kind of like find their own balance, our own. So yeah, that image is really nice, by the way. So I want to say thank you so much for watching this video. We reached the end. A crown for you because you watched the entire video. Thank you so much. And yeah, basically this was kind of like the main type of videos in terms of kind of what type of ETFs to kind of like look at and the reason why and how so, let's say. So a little bit of reasoning. Of course, no financial advice. And as always, try to, let's say, do not just your own research, but also if you really want to approach the world of investing and saving and things like that, try to go to like a certified financial investor, like a certified financial counselor, something like that, not just looking at YouTube videos. I mean, look them because monetization, and thank you so much, money, hopefully. And yeah, hope that you enjoy, and I'm gonna see you at the next one.